There have been some concerns of late on the infrastructure space, capital goods space. Yesterday you saw stocks like L&T and BHEL being under considerable amount of pressure. The market fears that they might declare or disclose order book erosions when they declare results this quarter, which is why L&T is sub 600 once again. IIFL, India Infoline, has just downgraded that entire space with the exception of BHEL. They are not very bullish on these stocks at all. Sandeepa Arora of IIFL is with us right now. Sandeepa, morning. Thanks very much. Can you take us through first why you think capital goods as a space will be a relative underperformer compared to the market?
I'll put it this way, that if you see the FY02 to FY08, the period where the stock market surged, actually the cap goods space outperformed the broader indices. In fact, cap goods outperformed Sensex by almost about 34%. But starting Jan 08 onwards, we've seen the space actually underperform the indices by almost 12%. So what led to this surge? You know, the whole surge in 02 to 08 was primarily led by investments. Now, if you look at the investments and the cycle that we saw 02 to 08, private sector almost had a 50% share of that investments, and the broader share of the private sector in the investments tripled as a percentage of the GDP. The next largest contributor was actually the public sector, of which the share was almost 50%. So if you look at both of these sectors going forward, you know, the headwinds that led in this sector was large profitability in the corporates, and there was a lot of visibility at that time. Growth expectations were high, public finances were improving, and of course there was a broader availability of capital. If we look at all of these four parameters, you know, all of these parameters have gone into a reverse gear. So we are probably sitting in a position where order books have peaked, okay? Availability of capital has been very difficult. To top it, the cost of capital has gone up. All of these factors actually do not favor the capex cycle anymore. We're no longer seeing visibility on growth. So I think we're going to see further, problems in this area, which is why we've been more or less negative on the space. And as you've seen, the space has been negatively performing, and it has underperformed the broader indices.
Sandeepa, morning. There has been an expectation, though, post the fiscal stimulus packages that maybe public spending will increase, and in that sense there will be a greater thrust towards capital goods or capital goods business. You don't buy that argument?
That looks very difficult. I mean, look at the public finances. Like I said, the largest contributor was the private sector. And today, where the government finances are, given where they are, in fact, I think the private sector would probably recover before the public finances actually recover. So, let's say in a year or two, we see the private sector coming back. But the waning government finances will have to be, something that we'll have to take a call on, because it's going to be very difficult for the government to keep spending in a position where the government finances are very tight. So, in fact, I don't see that happening in the near term. It's only when we'll see both the private sector and the public sector contribute will we see, the capex actually moving back up. But I don't see that in the near term. So I think from a standpoint that India has seen a surge in investments, in fact we're sitting at a rate of 23% annualized increase in investments, which is one of the highest in the world. Given that backdrop, I don't see that happening in the near term.
What's the sense you get though, Sandeepa, when you talk to companies? I mean, are they seeing the kind of problems that you are envisaging? Are they talking about order books having peaked and pressures going forward? Or are they saying, no, things don't appear as bad as you are making it out to be?
While that has been true, like I said, up until now, in our recent conversations with most of the companies, we are clearly seeing stress levels happen. Most of the guys are, who had projected, let's say, a 20 to 30% growth, are themselves toning down those expectations. So I think in a parameter where you have the whole capex slowing down, the corporates themselves not seeing visibility in the near term, every corporate will cut down on its spending. And that's what will lead to the order book kind of slowing down from here. So while we may not have seen that so far, I think we're sitting at the peak, and gradually we'll see that position deteriorate. Another thing that is also visible is that you also have, foreign contractors that have come into this space. So your margins also take a hit. So there are a lot of headwinds, availability of capital, cost of capital, all of that is adding to the stress. So the key factor being that corporates themselves are now cutting down on further capex spends because they don't have near-term visibility. The growth is not being seen. So unless that actually revives the growth visibility, I don't think capex is going to happen nearly in the kind of rate that we've seen in the past. I'm not saying capex won't happen, but the rate at which it was increasing will slow down for sure.
By the way, as we speak, market selling off a bit more, down more than 20 points for the Nifty, and L&T actually is the one that's putting the greatest pressure right now on trade, 4% down on the stock, so it's slipped quite a bit. Sandeep, I believe your top pick though is BHEL. Tell us why you like it, and if at all you have a price target on this one.
See, the key reason, while I won't discuss price and price targets, the key reason we are positive on BHEL is, if you look at the client profile, it indicates a lot of demand visibility. So there is a lot of probably even unsatiated demand for its products. If you look at their customers, the balance sheets are far healthier. So that also is not a risk. So I think from these two standpoints, BHEL, is a far better bet in the space vis-a-vis any other. The visibility is better, and if you even look at that industry, fuel linkages are getting better. So things are looking more visible, rather more stable out there, which is why we tend to be a lot more positive. While I will not discuss price targets, we like this, and I think relative to the rest of the space, this stock will clearly outperform, and you've seen that actually. The stock has clearly been outperforming its broader peers.
That's true, Sandeepa, and the gap between BHEL and L&T has just got wider over the last few months in terms of valuations. Do you see this underperformance of L&T continuing? I mean, are you far less optimistic about L&T than BHEL?
Like I just mentioned, besides BHEL, I would avoid every other stock. While I won't comment specifically on L&T, I think broadly besides BHEL, I think portfolios need to be restructured to that extent, and we'd probably from the cap goods space only prefer BHEL.
I must ask you about the market, Sandeepa. We've had a fairly good rally which is beginning to falter since yesterday. How are you seeing things shaping up for trade?
Well, it's been a very good pullback, and we've been expecting this for a while, and typically in the downfall we've actually seen no rallies, so this has been a relief to that extent. Having said that, it's difficult to say how long the rally lasts. In the global backdrop, most indices look like in the near term they have peaked, including our own, which is why we're seeing stress today. But I think going forward, what will really lead anything on the markets is going to be political news. So we know that we have an overhang of elections, and I don't really see the markets rallying in a very big way. My sense is 2850 on the Nifty to maximum 3000 is where we would look at the market. So I'm not seeing too much of an upside. Having said that, we're not negative either. Like I said, downsides are also limited. So I think it's broadly going to be a very range-bound market.
Thanks, Sandeepa, very much. Today the markets